Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And let's get into our first question today. That is from Tammy. Tammy writes, firstly, I'd like to express my appreciation for your insightful podcast and blogs. Your candid and constructive advice on a wide array of topics has been great. So thank you, Tammy. That's my pleasure. So I'll just give you a rundown. Tammy and her partner, they're 46, young child in primary school, live in North Brisbane. The property's worth around $950. The debt against that, or the debt that relates to that, I should say, about $870. So they've obviously done that move just recently. The previous property that they lived at, which is outside of the city, outside of Brisbane City, is worth $850 with a $265,000 mortgage against it. And that's now an investment property. It's rented out for $670 a week, which is a pretty good yield, I would have thought. Their child goes to primary school. Anyway, they need to undertake some renovations to their house and upgrade their vehicle and need an additional $30,000. So what they thought they could do is increase the loan against the old place, their previous home, to fund that. And the questions that Tammy has for me is that refinance strategy a good idea? Should we consider any alternative loan structures, and would a novated lease be beneficial in terms of purchasing a vehicle? Did I mention their combined income is $200,000? That might be pretty relevant. Now, to me, the key question here is, do they keep the old home as an investment property? Because it looks like, their debt is topsy-turvy. You know, they've got an investment property with $265,000 of debt and a home with $870,000 of debt. Hopefully, if you had it your perfect way, you would turn that around and have a lot lower non-tax deductible debt and higher tax deductible debt. So then the question then becomes, for people in this circumstance, what should they do? Is it right to hang on to that old property on the premise that, or the thesis that people say, buy property, never sell? Or should they, just move on from that and reduce their non-tax deductible debt? Now that they've got to borrow for non-investment purposes like home renovations and a car, so forth, they can't just go and increase the previous loan. I don't know if Tammy was suggesting this, it wasn't necessarily clear, but there's a common misconception that if I go and increase the loan that is related to an investment, that's magically going to be tax deductible. It's not. So Tammy, if you go and borrow for these purposes, and let's say you're using that investment property as security for that loan, which is completely fine, my advice would be to either increase the $670,000 loan that's secured by your current property, or have a separate loan against the old property. So you've got to quarantine what is deductible and what is non-tax deductible. And because you're using these funds for a non-tax deductible purpose, being renovating your home and buying a car, you shouldn't mix those two types of debts from a taxation perspective. So 265, which is the loan that is attached to the previous home that is now an investment property, is all the gearing you're ever going to get against that property. So here's the thing I think about in their situation. As I said, they've got $870,000 of debt, soon to be much higher. If we assume an interest rate of 6%, that's $52,000 of interest. Now that interest is not tax deductible, so we've got to earn pre-tax dollars in order to pay that. So if we assume we're paying sort of 70% on average, it's about $75,000. So the opportunity cost of hanging on to a lot higher tax deductible debt is $75,000 a year. So for you to be better off by carrying that higher debt, you want that past home, that now investment property, to be generating a lot more growth than $75,000 a year, growth or income. And even at that debt level, it's probably not generating a lot of income, after all the expenses. So it's really about the growth. At 46 years old, I don't think you can take the risk that it's not going to do that. And for those reasons, if I was in your shoes, I would most likely sell the former home. You've got about $600,000 of equity in that property, which means that you can reduce your non-tax deductible debt to $270,000, something that is far more manageable. And then even if you go and do the renovations and buy the car, you might increase your debt to say $400,000. That's still manageable. And the point is that it'll allow you to make additional super contributions, hopefully with your cash flow. And then when you're ready, go and buy an investment property. And that way, when you go and buy an investment property, you can make sure that's fully geared did to also give you the full negative gearing benefits to help with the holding costs. And to me, I think that's going to be a much better use because it's really about opportunity cost, and there's a much higher opportunity cost associated with hanging on to non-tax deductible debt. So your first question is the refinance strategy most effective to achieve our financial goals? I think I would reframe the question is, should I keep the previous home as an investment property to achieve our financial goals? And I think my answer is that the non-tax deductible debt is just too much of a handcuff or an anchor that's going to drag behind you, that's going to retard your ability to build wealth. If you did hang on to it, just make sure you get a separate loan, as I said. I've answered the second question, which is alternative strategies. Sell the property, reduce debt, go and buy an investment property when you're ready. And novated lease. A novated lease is going to be, it's probably line ball these days, novated leases. The thing you've got to worry about or think about is the finance costs and associated fees. So a lot of these salary packaging companies, charge the lease arrangements and interest rates aren't particularly attractive, and they charge fees. So that's one thing. The other thing is, if you can buy a electric vehicle, it doesn't attract FBT. So essentially you get to use pre-tax money to pay for that. That's really effective. So if you're of a mind to buy an electric vehicle, salary packaging through a novated lease, definitely the best way to go. If it's a dirty old petrol vehicle, I probably wouldn't worry about it unless you had a high amount of tax deductible use, so business use for work and so forth. But thanks, Tammy. I answered the question that you didn't really ask, but hopefully that's helpful and helpful for all the people that are in or might expect to be in Tammy's situation. It's a really interesting one. Sometimes it's a good idea to sell property. And then sometimes, you look back and go, oh, I should never have sold, right? So I've done both in my life in terms of there's been times where I've sold property to reduce non-tax deductible debt. Thankfully, I'm in a situation where I don't have any of that anymore, but I've done that and not regretted it. So as long as it's part of a longer term strategy, and so for Tammy, it's as long as it's, okay, I'm happy to sell this year because the next 3 years I commit to buying an investment property, or I commit to, invest in the share market or doing whatever the strategy is. As long as it's part of a long-term strategy, selling a property to reduce debt is no problem. Okay, next question is from Viktor. Interesting that these questions kind of come in. There's always themes with these questions, isn't it? Okay, so Viktor thanks me for the podcast. Sometimes I feel like when I read the lovely feedback, it feels like I'm pumping my own tires up. But I like to, read it out because I respect people providing really positive feedback. Anyway, I just hope it doesn't come across egotistical or whatever. Anyway, Viktor's been very kind about the podcast, so thanks, Viktor. So Viktor is in a great position and has obviously made some great decisions over the last 15 years or so. And Viktor writes, my wife and I currently own our home and 4 investment properties. Our joint PAYG salary is around about $400,000 a year. Our investment journey started in 2010 when I purchased our first primary residence. We moved out in 2015, rented for 6 years or so to be closer to work. We used a reputable buyer's agent to purchase 3 investment properties, and it's no secret that Melbourne has been sluggish in terms of growth over the period that we've owned the investment properties, and as a result, much lower growth. Yes, unfortunately, the timing was very bad. With the birth of our first child in 2023, we're considering upgrading our primary place of residence to a standalone house, maybe around 600 square metres, in the best location we can afford. The purchase price is going to be around $2.5 million. Listening to your advice, it's more important that we secure a property in a great location with a workable floor plan that is between 10 to 20 kilometres from the Melbourne city. We're open to renovating an established home and adding value over time. If we did this, we'd need to sell our primary residence and plus possibly 1 to 2 investment properties. We would like to sell our apartment in Carnegie as it's not performed and the growth drivers are not as strong as the other properties. Our challenge is to decide which one of the other 3 investment properties to sell. As we've held these properties for a decent amount of time, we're unsure if we should sell them and reduce our asset base at potentially the start of another Melbourne growth cycle. Would it be better to wait and allow the growth to occur to improve our LVR and equity position so we have more options in the near future? I like having more money to spend on our dream home, yes. Noting the above scenario, if in our position, would you sell 2 to 3 properties at this stage of the Melbourne cycle to buy a primary place of residence And if so, which properties would you sell? And then Victor's kindly given me a rundown of all his properties. Oh, you got the home in there as well, and when he purchased and what they're worth now, and those sorts of key details, of course. So it's a really interesting one because it's a part science, part arts, I think, in terms of working out the strategy here. And there's a lot of value to do it, in doing it correctly, of course. So across the board, Victor's properties are worth about 5 million with about 3.7 million of debt. So he's got, quite a bit of equity there. In terms of deciding which assets to sell, the factors that you need to consider, how much equity in the property net of tax and loan will you walk away with? Because selling an investment property, if there's not a lot of equity in it, it's not necessarily going to help you in terms of capacity. I mean, it will reduce your borrowings against that asset, of course. But I'm thinking about, okay, if we're going to upgrade, can we cash out of some of these properties and use that cash towards an investment property? And the way that I'd be thinking about it is what I'm doing is I'm taking that equity out and reinvesting it in arguably a better quality property, because Victor said he's going to buy in a good location, good land component, and potentially improve the asset later on. So that's the first thing you've got to kind of work out is which ones are going to be most impactful on your borrowing capacity, because that's the key thing, is to try and get into that market as soon as possible. The other things you're going to think about are capital gains tax as well, and cash flow. If you've got a property portfolio, for instance, and there's one property in there that's delivering substantial positive income and offsetting all the others, if you go and sell that, all of a sudden you've got a cash flow problem because the costs are too high. So you've got to really consider cash flow, the amount of cash you can walk away with after you repay the loan, selling costs and capital gains tax. And then the other thing you want to think about is then future growth. And you don't necessarily extrapolate past growth to equal future growth. And I'm going to make this point a little bit clearer in a second. But ultimately what you want to do is think about which asset am I least convinced, even with the backdrop of a potential growth cycle, that it's going to underperform. And so this takes me to the next bit, which is, do you do this now or do you wait for the growth cycle? Well, then you've got to think about relative growth. So you've got to think about, if I'm going to buy X property in a particular location, strong land value component, blue chip suburb, versus the assets that I hold today, percentage-wise, what is the growth differential going to be? And the reality is that better quality assets will grow faster in a high growth market. Everything grows. So in a rising tide, all ships rise. But the good quality assets, that's when they tend to outperform, is during a growth cycle. So the problem is, if you hang on to some of these properties and you acknowledge that they aren't perfect and they're an inferior quality compared to what you want to buy as a home, then your risk is, by hanging on, you're going to get priced out, because the target property that you want to get into is going to cost a lot more in dollar terms and percentage terms than what your properties will produce in terms of growth. So I think, particularly we're buying a really good quality asset that is going to be tax-free. I'd be keen to do that. If I was in your shoes, I'd be keen to do that now. Now, it's funny, Carnegie Apartments, I mean, there's a lot of apartments built in Carnegie around sort of shopping strips, train station, and so forth. There's quite a bit of supply going back sort of 10 years. And that's kind of affected prices in Carnegie. I think it's a good location. I note that Victor's is a 1970s block of one of six. So it's probably investment grade location, but a typical story of investment grade apartments. Although he doesn't have a lot of equity in that property. I know that listeners can't see this, but there's virtually no equity in that property, but it does alleviate borrowing capacity, right? So this is a thing you need to work with the mortgage broker to work out, well, if I sold Carnegie and Endeavour Hills, what is my borrowing capacity? What is my cash flow situation? You've just got to kind of scenario analysis, analyze it a bit. Again, that's that bit. And then the part two is really thinking about future growth. So what can Carnegie do? It's worth about $550 now. It's a 2-bed, 1-bath, 1-car apartment. Well, that could, because of the underperformance over the next decade, that could double. So you got $500,000 of growth there. The other properties, Victor has 3 houses, one in Hyatt, one in Hadfield, and one in Endeavour Hills. The Endeavour Hills was the first one he purchased back in 2010 for $380. It's now worth $950 according to Victor. So you've got almost 2.5 times growth over that period of time. Hyatt's a really good kind of Bayside location. I really like Hyatt. I think I haven't looked at all these properties, by the way. It looks more like a townhouse, perhaps. I don't have the addresses. And Hadfield I don't know that well. Viktor bought it in 19 for 830, and it's now worth a little over $1 million. So it's not too, I mean, it's not too bad. It's not great, but it's not too bad. I think, I don't know why Endeavour Hills is so expensive. I get the ripple effect. I think it adjoins Doncaster, so I get the ripple effect. But I think the thing you've got to think about, and I've recorded podcasts about this, is that will the people that live in Endeavour Hills be able to afford to pay $2 million for that asset? So Endeavour Hills, which is the one he's owned the longest, is now worth $950. So, if it doubles in value, it's $1.9 million. Where's that borrowing capacity going to come from? Do they have income growth in that area that's going to propel that price forward? Now, remember, I talk about areas kind of get to the median, and then once they struggle to get past the median value, because the ripple effect continues on. And Endeavour Hills, I mean, there's a few national parks there, or parks, but it can still spread out from there. You can do your own numbers in terms of how it will impact cash flow, but how it will impact borrowing capacity and how much equity you're going to pull out. But I think I would lean towards selling Endeavour Hills and Carnegie. The other thing you could potentially do then, if you thought you needed longer term to sell a third investment property, I would work out, can you sell Carnegie and Endeavour Hills and then go and buy the target property you'd like and rent it out for a period of time, and then continue to hold all the other assets, including your home, through the growth cycle, or at least for another 5 years, and then sell your home and move in? Like, that would be a good strategy where you're kind of hedging your bets, or taking a bet either way. But I think I'd go down, if you had to then, if that didn't work, then you could sell Endeavour Hills, Carnegie and your home and complete that upgrade. Isn't it ironic that Endeavour Hills was the previous family home, and it's probably the investment that's done the best? Of course, it's the investment he's held the longest, but I find that a little ironic. That would be another reason to sell it, by the way, because the intent of buying that property was personal use rather than pure investment use. It's just unfortunate at the period of time he's held the properties that were bought purely from investment perspective and fundamentals just haven't performed, and that's natural. I mean, that is Melbourne, unfortunately. So it's not reflective of the asset quality necessarily. So there you go, Victor. I hope that's useful. At least talks to some of the things that I think about, and it's a common scenario that people come across. So if, for those that have been contemplating doing the same sort of thing, it's fine. It's okay to sell investment properties. It's okay to sell other properties. It'd be great to never have to sell, but that's not usually realistic. And I'm talking in a few weeks about, well, actually end of next month. I've written and recorded some of these in advance, given I'm taking a bit of a break, but talking about return on borrowing capacity is a topic that's coming up. And it's really about, the premise is really about allocating borrowing capacity as efficiently as possible. So from a wealth accumulation perspective, borrowing capacity is your scarce asset, not properties. Anyway, so that sort of link ties in with that one. But good luck, Victor, with all your decisions, and I hope it works out. And well done to date, by the way. It looks like you've made some great financial decisions, and you're on a fantastic path there. Okay, next question is from Adam. Bit of an easy one this time. Thank you for a wonderful podcast. Listen twice a week without fail. That's fantastic. Adam, thank you for listening. My question is regarding access to super at age 60 and the condition of release required to meet it. If I have 2 jobs, one full-time, one part-time, and after age 60 I quit my part-time job, what happens? My understanding, I can access my super. There seems to be a bit of confusion on various websites of which super I can access. Can I access all super, or only the amount that's related to that particular job that I've resigned from? Or do I have to quit all jobs? Would love some clarification in this area. Okay, Adam, really great question, and it's a little bit of a loophole at the moment, and maybe I shouldn't talk about it because, the government loves to close loopholes. Okay, so there's a few conditions of release, but let's talk about the age-based and retirement-based ones. So the law states that if you are 60 and you have permanently retired from the workforce, so that is that you are not gainfully employed and you don't intend to be gainfully employed in the future, at 60 you can access all your super. If you are still employed, you have to wait until 65. So regardless, at 65 you've got full access to super. There's no partial access. Doesn't matter if there's contributions from a particular job. It's really just a case of, it's super. Are you working? Are you not working? Once you've met that condition of release, you can then start a pension, which means that you must draw a minimum amount each year, but there's no maximum. Or you can take lump sum withdrawals. So you can take all the super out at age 60 if you've stopped working if you want. Now, I wouldn't suggest doing that, of course, because super is a very tax effective environment. In fact, the strategy should be to try and keep as much inside that super system as possible, but that's how it works. Now, what does permanently retired from the workforce mean? Well, to access your super, either the ATO or your super fund might ask you to sign a declaration that confirms three things. You've ceased gainful employment, you've reached a preservation age, and you do not intend to return to work for which you are paid in any capacity, either full-time or part-time, in the future. Now, if you do start a pension, then you subsequently work again, what's the impact? Well, nothing. Here's a little story. You decide you're going to stop work. You tell your boss, you know what, I'm going to stop work. That's it, I'm done, and you resign. So you contact your super fund at the end of that week and say, okay, I've resigned, I'm going to start a pension. In a week's time, you change your mind and then go back to your employer and say, I've changed my mind, I had a week off and I want to come back to work. Your employer re-employs you. You have then met the condition of release. You can start a pension, start accessing your super. There's nothing to stop you doing that. It's just about, the law just says, for you to access your super, you have to genuinely believe that you no intention of returning to work. But, it's pretty flexible. And I haven't come across anyone that has sort of run into trouble by doing that. I mean, at the end of the day, you can change your mind, right? You can retire and then decide it's not for you and go back to work. And that could happen in the space of only a few hours. Anyway, that's how the law works. That's how you can access your super. It's really just about having a situation where you can sign a declaration, say, I'm not currently employed and I don't intend to regain employment in the future. Hope that clarifies that for you, Adam. Thank you so much for your question. Okay, next question. It's a bit of a monster, so I'm probably going to go over time today, but it's from Norm and Cherie. Norm and Cherie write, thanks for the podcast. My brother put me onto it about a year ago and have been hooked ever since. It seems you have quite a following in WA, as I hear a lot of questions come from here. Could be market related, I guess, but good to have listeners all around the country. My wife and I are about to turn 50. We have 3 kids, 14, 16, 18. The 2 youngest are still at expensive private schools, but the older one still lives with us. I imagine they'll move out sometime over the next 20 years. Yeah, I hope so. We have a small business which has been good to us over the last 14 years since we started it. We have no work outside of this. We're still active in the business, but hope to reduce dependency on me over the next 5 years, although still be involved after that. We run our business through a family trust. We don't draw a wage, but I expect to be able to distribute $700,000 to $800,000 a year. So obviously business is doing well. Congratulations. Structure took me a little bit of time to get my head around, but I sort of understand it now. And then Norm and Cherie give me a list of their assets. Their home's worth 4.2, owned outright, investment properties, 2 investment properties, about 1.6 with about, 700,000 of debt. Gee, that's pretty poor maths. $500,000 of cash, 320 of ETFs, and then super of just shy of $1 million. I've swung between being too conservative or too risky over the years, and I'm trying to break myself out of that cycle with poor choices and inactivity. We've had good results from property investment across the years and universally poor outcomes from investing in share investments. After listening to your podcast, I can appreciate my results were more because I didn't follow an evidence-based principles. However, things are still pretty sketchy with old mate Trump in charge of the asylum. I've been increasing my exposure to ETFs over the past 12 months. 2 of our investment properties are okay. They've risen with the Perth property values. Listen to your recent podcast about investing in defensive investments, and I'll move my cash over to those positions. And despite our failings, we're not too far from a perpetual portfolio that I learnt about in your podcast. Now, there's a couple of questions, one about a commercial property and one about buying a holiday house. I just want to pause here. I don't want to turn this podcast into a sales pitch, but I mean, when I see something, I've got to comment on it. And it's really funny, people sort of say, well, they recognize their mistakes. They're challenged with, what is it like, going between being too risky and too conservative. The problem is we're emotional about our own money. And whereas we need to be really practical about our own money, that's often difficult to do. It's difficult to do for your entire life consistently. It's even, I mean, it can be challenging to do as a financial advisor, not only for my money, but for my clients' money. But it's my job, so I have to. And, there's a strong element of coaching in and accountability with financial advice. That you go and pay the financial advisor a fee, you have to make a decision. Or you actually can just leave the decision making to the financial planner. But either way, a decision's going to get made. And it's a little bit like paying a gym membership or a personal trainer. If I pay these people money every week, I feel kind of obligated to get off the couch and go and exercise, because otherwise it's a complete waste of money. So, apart from the practical aspects of it, in terms of the advice and the structuring and all those sorts, they're very important. There is that accountability aspect to it. Now, that's a double-edged sword, right? Because sometimes people are scared by that. Because it's scary, you then got to take action and you've got no excuses. Whereas at the moment, you've got excuses, I can't invest because of Trump or whatever. And by the way, I should say, every situation has some uniqueness with it. There's always a really good reason why not to invest. So I'm not saying, well, Trump is, politicians come and go. I mean, Trump's unique and it's creating unique risks, but it doesn't mean we stop investing. We might change the way we invest, but we still must invest. Anyway, I'll get off my soapbox because I don't want to be sitting here preaching to you. But when I see that, I don't like to, I'm quite practical, as you know. I talk about the numbers and the spreadsheeting and the really practical elements, but those softer elements around relationships and, having a financial advisor and that accountability, I don't talk about it enough probably, because I see it myself. It really holds people accountable and things get done, investments get made, and, presidents come and go, but at least you've made some progress. Okay, so Norm's and Cherie's first question is about buying a commercial property that they can operate their business from. So they could buy a 300 square metre office with 8 parking bays, 6 undercover for $900,000. That could rent for $80,000 a year. So they could pull their super, because obviously they got $1 million in super, and pay for it outright, and the return would be 8 to 9% in terms of income. Assumed capital growth at 3%, and the benefits are the location's excellent, fit for purpose for my business, suitable for the business if we were no longer to be a tenant. Building is older, 8 owners, so it looks like it's a strata titled office with 8 other owners, and there's vacant land that could be potentially redeveloped, although Norman Tree have correctly identified that might be difficult to do when you've got other owners. The downside is you're putting all your eggs in one basket, lack of liquidity, although Norman Tree say that they've got enough time to build up diversification. Okay, so should they do this? I think that's is it advisable? Actually, sorry, I didn't see the next questions. Seems like we have the equity to invest, provides security for the business, gearing not a focus as only 15% tax environment inside super, will generate good yield now. We could sell without paying capital gains tax in 35 years. Well, that's good. You can save capital gains tax on what, 3% capital growth? You're not going to save that much tax. I just don't get it. I don't see why you would do it. So, Pro Solution, my business, occupies a lease in the office, has always leased. The leasing costs are ridiculous. I would never buy an office. I can't conceive I would ever buy one. I just don't understand it. And the good thing with this, I don't know, say rent for 80,000, is that the market rent? Because what I'd be really interested in is what the market rent is, because it's a 8.9% yield. I'd be surprised if a normal office tenant is going to pay that sort of money, or whether that's just inflated rent on the high side to get more money into super. But I think if we can return back to evidence-based principles here, that you're 50 years old, I think you've got a plan to live another 50 years. Hopefully we all live to 100, but, these days I think, if you plan to live to 80 or maybe 90, and I think be conservative, plan for 100. So it means you've got 50 years potentially of living left to fund. It's too early to turn to a defensive asset now. Why would you invest all your super in an asset that's going to give you 9% income and 3% capital growth? So 3% capital growth, there's no real growth. Your money's not growing. It's just your 9% that you're getting that you're going to pay tax on every year, and then sure you can go and reinvest it. I don't buy into necessarily, because it's just an office, it's a vanilla sort of commercial property. I don't think, security around business, that sort of stuff. Yeah, okay. okay, but are you going to put all your eggs in one basket? I don't know. I just don't think it doesn't resonate with me. If a client goes and buys a unoccupied commercial property, to me it makes sense if there's a huge fit out cost, so to give security around the fit out, and you can own the fit out outside of the super fund, for example, to get the better depreciation benefits. Or if there's some goodwill, so medicos, for example, if you've got a dental surgery or a GP surgery, you might want to own that location because that location's always been a GP practice, for example, and has some goodwill with it. I get that. In this situation, if it's just a generic office, particularly if it's a strata office, because one of the big things with properties, you've got control, full control. You don't have full control here. You're just one of 8 other owners. So, that doesn't excite me. And as an investment, Norman Sharia, nearly 50. Like, they're still got to be investing for growth. Now, I spoke about last week property fads, and I realize commercial property investing is a bit of a fad at the moment. There's a lot on social media about it. You can read a lot about it. There's a lot of people espousing the benefits of it. And it might seem attractive because you bank the return today. The good thing with income returns is they're predictable and they're going to happen. The problem with capital growth returns is they're uncertain. Yes, but as long-term investors, we don't need to worry about that so much. So, sorry, Norman Sheree, I'm not a big fan of that, putting all your eggs in one basket. I really just don't get the upside or the benefit of doing that. I think it's just the wrong investment for your age and stage of life. And I don't think there's any unique benefit to the business necessarily either. Okay, next question relates to buying a holiday home. Considering buying a holiday home to, be able to get away and something for the family to use, would expect to spend around $2 million. What structure would be best to use? We have an investment trust, but I was wondering about your suggestions about using a corporate entity. We have one of these already, a corporate beneficiary. Is this appropriate in our situation? We need to be able to negatively gear to make it palatable. We appreciate the requirement to have it available to rent to make a claim on the property as an investment. Should we draw the dollars from the bucket company to help funding this, maybe through an offset account? Is there an efficient way to do it? Well, Norman Shree, you said that your business was structured as a trust, so you've got some discretion around where you want to distribute. There's a couple of things you want to think about here then. You want to think about negative gearing in terms of making it palatable to hold on to the property, make the interest tax deductible, that is. You want to think about then your distribution strategy, like how you're going to deal with the profit distributions. And then you might then think about longevity of that asset, through generations in terms of handing over to your kids and doing those sorts of things. So for those reasons, I think I put it in personal names. And the reason I say personal names is that if you were my clients, I'd be distributing $190,000 to each of you, so up to the highest marginal tax rate, because, if you put money into a corporate beneficiary before you get to that point, you're not really optimizing taxation rates, because ultimately it's about getting the money out of the corporate eventually so that you can spend it or invest it in other things. So therefore, if I put the property in your personal names, it means, and I've got negative gearing, it means I can distribute more to you. I can still try and keep your taxable income at 190 after the negative gearing deductions, but it means it's more tax effective because I'm going to save every dollar that I distribute to you that can be offset by negative gearing saves you 47%. So that's going to maximize your negative gearing benefits. There's no additional land tax in Western Australia, as far as I understand, for owning property in a trust, but there is in many other states. So I think it's a little bit of a hint to people to not get caught out that if WA, and I don't think they really need to raise taxes, but if they wanted to raise taxes, that's a really easy one for them to roll out because it exists in other states. So I'd be cautious then about putting it in a trust because I'd be worried about will they change the land tax rates just like everywhere else. And then the other benefit of having it in your personal names is that through your estate, your will, you could have that asset move into a testamentary trust. So when you both pass on, that goes into a testamentary trust. It's going to be really tax effective for your kids, and it's an environment where that property can exist for potentially multiple generations to use. So I think it ticks all those aspects. I don't know your full situation, and just like everything in this podcast, it's not advice, but it's just information. But based on what you've told me, and I don't know if you've told me everything that I need to know, of course, that's the way I would approach it or look at it. Okay, that was a monster one, and I well and truly went over today. Apologies for that. My colleague Campbell Wallace joins you tomorrow. He's got a great blog about land tax, the insidious nature of land tax. And got some really good insights and statistics and numbers to share with you, and he'll do that tomorrow. And I'll be back with you next week. Cheers. Just a few things before we wrap up, if I may. Of course, you can send me questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.